Now I'd like to move for my last function, which is to introduce Charles. Charles is the president of Brandis Investment Partners and is well known not only in the consumer area, but even better known among institutions, so-called smart investors who know that he, as a value-oriented manager, can do very exciting things. For example, we invited him to speak last year, but it was nice that he handed us this little ditty, that is that emerging markets are up 3% for the year, and Charles's emerging market fund, which is in virtually all your portfolios, is up 14% for the year. Or is it 15 with what happened today? In any event, he's got I wanted to mention, he's a graduate of Bucknell, but I wanted to mention that there are two types of managers, what I'll call management companies. The first type is called the marketing type. The marketing type is like Bloomingdale's. Now, I don't know whether you all know this, but I remember when Bloomingdale's sold paper dresses at full prices for people. People wanted paper dresses. Bloomingdale's gave you paper dresses. And there are people who, you want technology at its peak? We'll give you that, because what we're interested in is making money. Isn't that the American way? And then there's the Charles type, who say it's not how much money we make, it's what is good for our clients. So when did Charles start his firm? 1974. 1974 is roughly equivalent to 2008. That you're more familiar with, right? So, and obviously his management company has done extremely well over the time. So I'd like to introduce to you Charles Brandis.
Well, good evening, everybody. What a impressive and good-looking group you are. I'd like to first of all, thank Altfest for inviting me very much. Thank you. Thank you very much. But I want to let you know that I'm disappointed. Lou, I'm disappointed. That is, when I got the invitation, they said that it was going to be for Hamilton, for the Hamilton room. And I was a little confused, because I understand that Hamilton is so popular these days on Broadway that some people are paying $10,000 a ticket to get into Hamilton. And I thought, well, thank you very much. Karen, thank you very much. I thought you were going to give us tickets to Hamilton. And here we are, just in the Hamilton room. Well, I guess I'll have to put up with that. And again, though, thank you very much. I think before I get started to talk about emerging markets, I'd like to talk about a little bit about investment principles in general, to remind us exactly what we're trying to do and how we should do it and how we should think about investing in the world. You know, there's a lot of problems today that we are all very well aware of. Are we going to come into a recession? We don't have interest rates very high. There are certain parts of the world that are very disturbed right now. There's lots of things for us to worry about. So what I would like to do is let's really think about what has happened in the wealth production in the world, say over the last 100 years. In spite of wars, in spite of recessions, in spite of depressions, in spite of inflation, in spite of all that, over the last 100 years, real wealth in America has increased by 17 times. If you believe that, after all of these problems and all the problems we have today, and the problems we have today are not any worse than what they used to be. Hasn't only changed that much. But still, we have 17 times more real wealth over that period of time. So where did that come from? I think as investors, we need to think about where that wealth is produced and how it comes about. And sometimes I think we forget about that because we are so worried about what is happening right now and all the potential risk and everything that could be bad in the world. I think we kind of forget about where that real wealth comes from and where is it going to come from in the future, and how are we going to, as investors, participate in that growth of wealth over the world. So it's a very simple concept, but sometimes we forget about it. Where is new wealth produced? How is it produced in the world, and how is new wealth produced in a free enterprise economy? Now, if anybody wants to make a answer to that question, I would be very happy to take the answer that you have. Nobody knows where wealth comes from? Well, we've got to figure that out. And how wealth and new wealth comes about is because businesses are increasing the productivity of goods and services manufactured and getting it done more efficiently and faster. And that's what creates new wealth. Now, why am I talking about this? Because I think in our investment program, we ought to think about that, that basic fundamental thing about how wealth is actually produced. And my point is that what you really want to invest in is contrary to what a lot of things that you hear from Wall Street and all the new things that Wall Street comes up with and all the new techniques and all the mathematical equations and all of the things that you have to do to analyze the stock market rather than analyzing how new wealth is produced by businesses over a period of time. So instead of all of this very complicated things, we ought to think fundamentally in our investment program where this new wealth comes from, and of course it comes from businesses that create that additional efficiency to create new wealth. So basically, you should be investing on a fundamental basis, thinking about owning the business that's creating that new wealth for you over a period of time. And it's as simple as that. And you don't have to be so complicated and thinking about so much about what Wall Street is doing for you in the things like the macro hedge funds and risk parity. I'm going to name some of this stuff that I don't think any of us understand a whole lot about it, and portable alpha and all sorts of new concepts that have to do with mostly analyzing the stock market and not really analyzing where new wealth comes from. So I would suggest that we think about these fundamentals. So a little bit about risk. We talked a little bit about risk already. One of the mistakes that I think is being done about the definition of risk, and as Lou mentioned, we do a lot of work for large institutions and large pension plans and invest for them in endowment funds, college funds, things like that. I find today what is their thinking of these boards who are making these investment decisions are amazingly different to me. Part of it is because of the market decline in 2008, 2009, but they're not concentrating on the long-term new wealth production. They're not doing that at all in the big institutional marketplace. They're concentrating on short-term stock market thinking and short-term reduction of volatility, and they're making the definition of risk only stock market volatility. Now, for some people, risk, stock market volatility is a portion of risk among about 4 or 5 different elements of risk that you need to think about. But what is real risk for a basic, fundamental, long-term thinking investor versus a speculator in the stock market? And that is, how do those businesses that you own do in creating this new wealth over a period of time, and not what the stock prices are doing on a short period of time in the stock market. And I think that has become a very bad thing for investors in general and for these big institutions in general, because they are thinking about this as their number one criterion. And they come and say, okay, we've got $10 billion to invest. Our number one criterion is that we don't want the quotations on those investments to change very much. That is what we really consider risk. In some element, it is a little bit of risk because they need to take out, whether it's 5% a year for their benefactors, or an endowment fund needs to spend a minimum of 5% a year. So they have to have the ability to take money out of the account. But other than that, and that downside risk might be involved there a little bit, but other than that, risk is not what some crazy and stupid stock market tells you that risk is, from a standpoint of volatility of the stock prices changing constantly, day to day, month to month, year to year. That is not risk. Risk is, over the long period of time, how those companies actually create new wealth. And the only other thing, people from Altfest mentioned it too, which I think is an important element of investing. And you have to be aware of the fact that there is a very large behavioral element to investing. And you can make mistakes because you're all human beings. You're all very intelligent, I can tell that. But you're also all human beings. And human beings have this tendency, and it's been built in for a long time, to be emotional over the short term. And human beings also have a tendency in general to think about what is happening next month or the month after, and not to think about the financial advantage of owning businesses, how those businesses do over a long period of time, even though they do go through ups and downs. And that is a natural thing, but we as human beings are not prepared. We have not been trained, or we haven't been around to be able to handle those things very, very well. And therefore, we make major mistakes. And emotional mistakes, the same old fear and greed mistakes. We make mistakes where I could not, as an example, in 2008, I got so enthusiastic about equity prices. Things were absolutely unbelievably cheap. I would look out my office window, and everybody thought in 2008 that the whole world, the whole economy was going to completely collapse, and nothing was ever going to work again, and that it would be worse than the 1930s, and it would take ever. And I would look out my office window, and right out my office window is Interstate 5 in San Diego, and I'd look out there and say, wait a minute, the economy is still working. I'm seeing a lot of trucks and a lot of traffic continue to go back and forth. And then I look at the price of these companies in 2008, and I say, the prices are reflecting the opinion or the fear that all these companies are going to go out of business, or they wouldn't be this cheap in the price in the first place. I said, that doesn't make any sense. Makes no sense at all. So I was trying to tell clients and tell you've got to increase your investments. Don't think about selling now. You've got to increase your investments. How many did? Maybe by 1 out of 100 when prices were so low. And of course, as we know, things recovered very, very substantially from there. And if you had been investing up until March of 2009, when the market turned around and hit its bottom, you would have made a fortune. And if you had made additional money, could I get people to put additional money in? No. Could I get people to quit? Yep, they were doing it right and left, right at the wrong time. So you've got to be aware of that, and it's very hard to do. This thing about value investing is quite simple, but it also is very, very hard. I got a little story for you. I got started in 1968 in the investment world. That was the go-go era where everybody was making so much money, and the mutual fund managers of that day, which were called the Four Freds, the Four Freds were making 30, 50, 100% a year. And everybody was so happy and so enthusiastic. That's what I got started in. I said, wait a minute. I was a basic economics undergraduate, and I said, this doesn't make a whole lot of sense to me that you can make that amount of money a year and everything would be happy and great. Well, 1970 came along, and all those guys got wiped out, and the Four Freds got wiped out, and it was obvious that what was going on was crazy and wild in Wall Street. So I got that lesson right away as a rookie in 1970, seeing these people get wiped out. And then one day, in the office I was in, an older gentleman walks in. He wants to open an account. And after the 1970 bear market, nobody wanted to buy equities, even though things were extremely cheap. Nobody would buy them then. But then this gentleman walked in, so I sat down to open an account for him. And it turns out that his name was Benjamin Graham. Benjamin Graham wrote the Bible of our industry called Security Analysis, first in 1934. And he is considered the father of value investing. And he was the teacher of the best investor probably in history, Warren Buffett. Taught him at Columbia University, right here in New York. And I had the opportunity to meet him after a very bad bear market. And Ben Graham taught me about fundamental, long-term value investing. And I was ready at that time. And I would talk to Ben about investing. He liked to teach. He was an adjunct professor at Columbia. And so that was the beginnings of my career in value investing. And it has been a wonderful experience. And it has worked very, very well, extremely well. But I want you to know that it is not as easy as it sounds, because all it says is you buy companies and you don't worry about the stock market or the prices or where they're going until you can get those companies at a large discount from the basic intrinsic value of what that company would really be worth on a private basis. Because the stock market is wild and crazy and stupid, and sometimes you can get it at a big discount. And that's pretty simple. But be able to do it when things are pessimistic in the world is very, very difficult. So what I want to finish talking to you about a little bit is about emerging markets. Everybody in general has been afraid of emerging markets. And until very recently, emerging markets hadn't performed very well. Their stock prices of their companies hadn't performed very well at all. And so everybody, but the developed markets, especially the U.S. market, has been extremely strong. And so nobody wanted to really have anything to do with emerging markets. And don't you know that emerging markets have big debt problems? They have population problems. They have corruption problems. They have inflation problems in emerging markets. And if the Federal Reserve is going to tighten up, that's going to really hurt the emerging markets. And the emerging markets have always been something that have always had trouble, whether it's political or whether it's corruption, or the stock prices of emerging markets have been much more volatile than the stock prices of the U.S. market. And so nobody wanted to really invest in emerging markets. That is something that's way out up in left field, to use a baseball thing, and nobody really wanted to go there. But there's just one statistic I'd like to tell you about emerging markets. Now, I don't want to bore you with statistics, but this is kind of amazing. If you look at global gross domestic product, all the wealth being produced in the world on a year basis, emerging markets constitute 42% of the whole world. Now, if you take something like purchasing power parity, which is another statistic, by the way, got to be careful about any statistics, including the ones that I give you. But under purchasing power parity statistics, when you look at currency conversions, the U.S. is second in the world to China as far as the size of the economy. In the U.S., outside the U.S., on purchasing power parity, and just in the emerging markets, they're about 55% of all the world production, emerging markets. And nobody wants to invest there? 5% of mutual funds have investments. 5% of their total investments are in emerging markets. Global institutional equity assets, the institutional ones, 5%. That's all they have in emerging markets, when emerging markets are at least half of the total world's wealth production. I would say that doesn't make a whole lot of sense to me. You're missing a whole lot of opportunity. Plus, the emerging markets, as we know, for the last 10 to 20 years have been growing a lot faster than the American market, the European markets, all the developed markets have been growing faster. But you're not going to invest there? I would like to also give you some statistic about, another statistic, got to be careful about this, but so I will be careful about it, but I want you to know that emerging markets today, the price on the businesses, and some very good businesses and excellent businesses in emerging markets, are cheaper in history than they ever have been compared to the developed markets. Today, they're priced about at the same as they were at the bottom of the market in 2008. That's how cheap they are. There are crises, though, however, in emerging markets that make people so nervous about buying them. Back in 1996, 1997, that was the Asian crisis, where the Asian countries, including India and China and Korea and the Philippines, were having, and it went into South America. They were having currency problems, inflation problems, all sorts of problems. And the valuation of those companies got down very, very low. They're about the same level today. Back in the Latin American crisis, there's always people come up with these crises. they don't really understand that a lot of times a crisis can be a great opportunity for investors to get good companies at very cheap prices. Then we had the Gulf War, where emerging markets went down quite a bit during the Gulf War. We had as I mentioned, the global financial crisis in 2008. Now, it's been about 3.5 years, 4 years, where emerging markets have not gone anywhere price-wise. Normally, then, what you would say is, why in the world would I want to invest in emerging markets? It hasn't done anything for 3 or 4 years. Wait a minute. Think about this. Those companies have still been producing goods and services. They're still doing well. But the prices haven't increased for 3.5 years. Where would be the best place to invest? Obviously, you should very seriously consider investing anywhere where the short-term past performance hasn't been good. It gives you a much better opportunity, perhaps, to get good prices and do good performance for your investing. So all I would like to do is talk to you a little bit about those prices, of these fundamental prices for these companies in emerging markets. But by the way, before I do that, emerging markets can be a very different marketplace all over. We all put them in one category called emerging markets. But that is not really a good way to think about the world and to think about these countries that there's now Morgan Stanley International calls them all emerging markets. Give you a quick example. Let's compare Portugal, which is a developed market, to Chile, which is an emerging market. The wealth in Chile is about twice what it is in Portugal. The population is about twice as it is in Portugal. And their growth rate, the growth rate in Chile has been more like 4 or 5%. In Portugal, for a while, it's been 0. But Portugal is considered a developed market. Chile is considered one of these really risky emerging markets. And the prices of the stocks in Chile are about half the level of the prices of the companies in Portugal. And then, of course, you have China. China is considered an emerging market. That's ridiculous. India, I suppose India is more of an emerging market than China is, but still India is very, very well developed. And so you have to look as an investor as not as a group of emerging markets, but you have to look at the opportunities in various countries and various markets around. So, but in general, then to get back to emerging markets in general, I'm looking at our emerging market portfolio versus history. Price to book value is one way to evaluate a company, very simple way, and we do a lot more than just price to book. But if you look at price to book, in the emerging markets index, the emerging markets are trading at 1.4 times book. Historically, they trade at 1.9 times book. In our portfolio, because we're discriminating against where we go and what countries we go in, our portfolio trades at 80% of book. So you can make these distinctions beside what the emerging market index tells you and do a lot better in investing. Price to earnings ratio is another fundamental way of evaluating companies, and our portfolio in emerging markets trades at about 9 times earnings, whereas the U.S. market is now trading at about 17 times 17 times earnings. So they're almost half the level, the price level. Dividend yield on our emerging market portfolio is 3.4%, whereas the emerging market index, which I'm telling you to ignore, dividend yield's about 2.6%. So there is a tremendous amount of opportunity in emerging markets, which represent about half the world's wealth production. And if you don't have a good percent of your investments in equities in emerging markets, I think you're going to be missing out. I think what Lou said, emerging markets are going to grow faster than the developed markets. I don't think there's any question about it. There's no question that China is still going to continue to grow a lot faster than the rest of the world. And so not only do you have prices for good companies that are trading at about half the level in the market in this country, but you have faster growth. So that's my advertisement for thinking about investing other than outside the U.S. In the emerging markets, we are finding a lot of value in Brazil and have been doing very, very well there. We're finding a lot of value in Korea, and we're invested there in a big way. We're finding some other value in South America. One area that's kind of scary to the general population would be Russia. We started investing in some Russian companies a couple, 3 years ago. And our client said, wait a minute. We actually got fired. He said, are you that stupid to invest in Russia? Don't you know that Putin is going to start a war? Don't you know that he's going to nationalize all the companies in Russia? Don't you know that the corruption in Russia is substantial? Well, some of these things we did know, and other things we thought it was very, very unlikely. And what we did know, however, that you had the world's biggest integrated oil company. Actually, it's the world's third biggest integrated oil company now, completely independent from the government in Russia. The name of the company is Lukoil, but it was trading at about 20% of the level that an ExxonMobil traded at. And they had the world's biggest reserves of oil in the ground of any oil company in the world. That's what we knew. We didn't know what Putin was going to do about starting a war. We didn't know whether he was going to nationalize things. However, if you really knew what was going on in Russia, and I've been to Russia a lot, and I'm going to Russia next week, and if you really knew what was going on, it wasn't the attitude of the people, and it wasn't really the attitude anymore of the government to nationalize things. It was exactly the opposite, and it's still doing that way. And they were just talking about it last week, the fact that they are going to really encourage privatization, and they're really going to encourage the small companies in Russia to grow and to be independent of the government. Kind of interesting because the thought about that has been exactly the opposite. So we were able to take advantage of that. And guess what? Last year, Russia was the top performing market in the world. This year, Russia is the top performing market in the world. And what we've been buying are some very, very high quality companies. So you have to be able to think fundamentally. You have to be able to think about prices you're having to pay for it and not all the potential problems. But if you can get a great opportunity by thinking differently and maybe thinking correctly. You're not always going to be thinking correctly, and that's for sure that we're not always correct in our portfolios. But if you do think differently, that's the only way, in my opinion, and you think patiently, and you think long-term, and you understand basic fundamentals versus prices you have to pay for the investments, you're going to do very, very well. Thank you very much.